How does a tontine actually work? Imagine a group of 1,064-year-old ladies all coming up to retirement. None of them know how long they're going to live. So they invest whatever they can afford for their lifetime income needs into a trust, and the trustees will start paying them a certain amount every month for as long as they live. But over time, we go from 1,000 ladies down to 900 to 800, and the rule of the tontine is, if you're dead, you don't need the money. That money is shared with the other ladies to support their lifetime income needs in later years. The effect of this is that as the number of members in the pool shrinks, the amount of income being received by each member increases.
You have just heard from Dean McClelland, founder and chief executive officer at Tontine Trust, a lifetime income solution. We had the pleasure of hosting Dean before, at our 15th Tokyo FinTech Meetup in 2018. This podcast is an edited version of our 182nd meetup. 5 years have passed, and the focus has moved from Asia to Europe and now the US. So let us dive right in.
So what are we doing? Or what have we been working on for the last 5 years? I mean, why is it taking so long? What we're doing is actually solving what Nobel Prize winner Bob Merton described as the nastiest, hardest problem in finance. People have been trying to solve this since the 1980s, but actually it's finally done. What exactly is this great problem that we're trying to solve? Actually, it's living too long. These days, when you retire, let's say we're retiring at 65, a high proportion of people will end up living deep into their 90s, and obviously in Japan, that's even higher. A significant number of people may end up with their retirements lasting almost as long as their entire working careers. And this is why they're so worried. 6 out of 10 US baby boomers have said that they're more scared of running out of money in old age than they are of dying. Because I guess nobody wants to end up dependent upon Social Security, and even worse, they don't want to end up dependent upon their kids. So what's the problem? The problem is that, for example, in the US, they have 401ks and IRAs, or in Japan, they have the IDECO, I think is the right pronunciation. These are designed as pension plans, but they're not pensions. They're just an account that you draw money out of over time. And typically what people do is they'll retire at 65 and they say, okay, I'm expected to live to, let's say, 81 years old. So I have to make my income last 16 years. So they divide their balance by 16, and that's how much they withdraw every year. The problem with that is that this average life expectancy is only an average. 50% of people are going to die earlier, and 50% of people are going to die later than that average, which means that 50% are in danger of running out of money. What do people actually want to solve this problem? There was a survey done in 2017 involving 100 insurance companies and banks across the world, particularly Asia. What they found out is that consumers want an income that lasts them for as long as they live. They want a steady income that lasts the rest of their life. They don't want to pay high fees because they know that the lower the fees they pay, the higher the income they're going to receive. But the other thing, and certainly we mentioned this last time we were talking, was that they want their income to rise over time to offset the effects of inflation. People are no less keen on that feature now than they were 5 years ago. However, following the survey in 2017, all the insurance companies said, we appreciate this is what you want, but it's impossible for us to reconcile a product that does all of this. And it's especially impossible at a low cost. But inevitably, the world has woken up to that actual solution, and the solution is known as a tontine. Since we spoke a few years ago, back then, if you used to search tontine on Google, you'd come up with all sorts of sketchy results. Now you've got the position where the OECD are coming out and spending a huge amount of time explaining to the world that tontines eliminate longevity risk for retirees, and they enable higher levels of retirement income than annuities. The professors over at Swiss Federal Institute of Technology, which is Albert Einstein's old university, have put a number on it. And they've said that joining a tontine enhances your pension wealth by 87% with zero added risk. In a world where many people have not saved enough for retirement, this could make the difference. How does a tontine actually work? Imagine a group of 1,064-year-old ladies all coming up to retirement. None of them know how long they're going to live. So they invest whatever they can afford for their lifetime income needs into a trust, and the trustees will start paying them a certain amount every month for as long as they live. But over time, we go from 1,000 ladies down to 900 to 800, and the rule of the tontine is, if you're dead, you don't need the money. That money is shared with the other ladies to support their lifetime income needs in later years. The effect of this is that as the number of members in the pool shrinks, the amount of income being received by each member increases. If you're one of the lucky ladies that ends up now living into your 90s, instead of living on cat food, we're shoveling all that money out of the trust towards you because we have to return it to the members before they pass away. What are we doing? How are we solving the problem in practical terms? We're very close now to launching the My Tontine app. This will allow, say, retirees in the US or near retirees to download an app and create their own custom lifetime income plan in minutes. Obviously, as we've discussed, once they sign up for the plan, they can expect to receive a lifetime income that rises over time. Because of the current market conditions, we have done some engineering such that we can now ensure that all the assets underlying the plan are going to be guaranteed by the US federal government. It says 2 million, but we can extend that up to 10 million per customer. This will be coming direct to consumers and to banks and their clients in 50 states in the next few months/weeks. What's the effect? What does it do? Now we've gone from 50% of people running out of money because they live longer than average to everybody receiving a steady income for as long as they live, and 0% of retirees running out of money in old age. Generally across the OECD countries, particularly Australia, Canada, and the UK, we've seen legislation passed to enable tontines directly. In the US, they've still been focused on enabling annuities in retirement plans, and they've passed 2 pieces of legislation so far, and they've now made it possible that you can use your retirement plan to invest $200,000 into a life annuity. Still very complex, but in fact, we've jumped ahead of them and we've solved it so that they don't need to write any more legislation. Now you can get a lifetime income using up to 10 million by joining a tontine instead. Once we go to market, what's our confidence that people will be interested in this product? According to Adam Smith, tontines always outsell annuities, and the statistics prove it. For every 1 annuity sold, typically in the US in the past, it was 5 to 6 tontines sold. It's a blockbuster product that appeals to consumers. We know that. What is the state of the market in the US at the moment? Last year saw a record increase of 30% of sales of annuities, up to 300 billion. What this means is that of the 3 million US retirees that reached 65 last year, that means there's roughly 700 billion in assets belonging to people that are not satisfied by what's on offer by annuities, and they're still seeking a solution. Certainly, we feel that there's a very big opportunity still available. In terms of the risks that you most face in retirement, you've got longevity risk and investment risk. We've eliminated the investment risk by using federally guaranteed government deposits, and the tontine itself is the best longevity risk solution that we can think of, even more so than a fixed annuity from an insurance company. Team-wise, we've had to start rotating the team from European experts more to US experts because that is now our main focus. The roadmap now is that this year we're going to roll out in the US, the plan being that we'll go back to Europe next year and start rolling out products across Europe. And then as soon as possible, we want to get into Japan and Australia. Europe has actually been delayed 2 years by tax approvals. If that continues next year, then we'll be straight over to Japan. We'll just reverse the order of both of those. Business model wise, we've been looking for a way to communicate what our business model is. There's a very good example. There are a number of neobanks in the US or fintechs, such as Kasasa and Chime. Chime is a good example. They target mass market consumers with low fee bank accounts and debit cards. Their revenue model is that they share 0.57% of debit card fees, any money spent in their debit cards, they share that with their partner banks. They're 13 million accounts, 9th largest bank in the US, and they're valued at 25 billion. Our revenue model is that we earn the card fees, but our typical clients have much more assets than a Chime client, and we get to charge 1% per year on the assets under management for roughly around 25 years. The potential valuation once we start onboarding customers is going to be interesting. Why now? The OECD passed a legal instrument last year compelling all member governments, including Japan, the US, Australia, to adopt lifetime income solutions by default for their pension needs using either tontines or annuities. Certainly in the US market, there's 30 million savers retiring this decade with 10 trillion saved. And remember that 6 out of 10 of them are looking for a lifetime income solution. The last 3 years have seen a massive increase in the use of digital products. So, anyone that said previously, will customers over 50 be able to use your app? I think you'll find that they're even more educated now than they were 5 years ago. Uniquely, tontines are the only affordable lifetime income plan that makes it possible for you to keep up with inflation, because annuities just don't offer the right value.
Ultimately, you need to group people in tranches for this to work. So you need all of the 64-year-olds, and whichever way you cut it, demographically and ethnically and whatever else, and you can't have men and women together. So in the model that the US now allows, how is that going to work?
The way we're going to do it, initially when we launch, we'll have, obviously, as you said, we keep men and women separate because the ladies are always going to outlive the men. Then we'll bunch everybody initially into groups of 5 years apart. So if you're born between 1955 and 1960 in one group, and then there's other groups as we go on. But as we scale, as we get more members on board, we'll start creating narrower groups and we'll reform people into that. It's not going to be a problem getting started and getting the required numbers so that people can start relaxing, enjoying their retirement. That's it.
The PEP regulation in Europe looked very promising at some point. You mentioned some tax regulations. What is holding it up?
I did an interview on Real Vision TV a few years ago. I think it was published in February 2020. And I said, look, we'll focus on Malaysia. Malaysia has offered us this federal license that will allow us to roll it out across the whole Islamic economy of 500 million people. That was our focus. But then I was contacted immediately by these lawyers in Europe saying, look, we've just passed the pan-European PEP legislation. It's perfect for tontines. We made sure it is, because we love what you're doing. They said, come and launch here. So I thought, okay, this is going to be a better way to start. We structured everything to launch out of Ireland across Europe with the new legislation. The problem is nobody in Europe has decided how they're going to tax this. We know how it's going to be done, but nobody wants to give in and just say, okay, this is how your pension is going to be taxed if you're moving around from different European states. We've been waiting 2 years on this and it's just nuts. But in the end, I think they did us a huge favor because now we're fully focused on the US. It's the largest single pensions market in the world. It's one tax authority and it's one language. It makes much more sense to roll out the model in the US first.
So the tax issue in Europe is a portability question because you essentially inherit assets or the use of assets from other people. That had been solved and it's solved in the US as well.
Yeah, I'm not going to explain on call how we solved it because that's kind of the secret sauce. But actually, it's incredibly simple in the end. I've been reading US legislation for 14 months, and it's actually very straightforward. Yeah, we've solved it. In Europe, it's not even about the tontine credits. It's not even about the mortality credits. They just haven't worked out how they're going to tax a pan-European pension that allows people to live anywhere in Europe and save into a single pension product. They just can't agree on it yet.
It's one of the fundamental things you should resolve when putting such legislation out, right? You refer to the OECD framework. Is there a timeline based on which this needs to be implemented? Because when we have seen stuff from the G7 and G20 on crypto and so on, all of that stuff takes a decade then ultimately to implement, which is still a long time for a startup.
Unfortunately, they haven't come out and said 2030. That would be nice, but they haven't done it that way. The pension world innovates over centuries rather than over years, as we found out. But they passed the legal instrument. It's the second most strongest legal instrument they can issue. Technically, it's only a recommendation, but in OECD speak, that compels the governments to adopt it. If you think about the US Social Security system running out by 2033, the pressure's on. The pressure's on everybody to get this solution deployed.
It breaks down into an accumulation and a decumulation phase. So even 2033, if people haven't saved yet, they wouldn't have the 10 million or even a million. So you still have the gap. If everybody started in 2023 or 2024 to accumulate into a tontine, then this current generation we have covered, but the gap from 33 to whatever, 66 still exists.
Yeah, when we launch, we're going to focus on those that specifically need the product immediately. So mass affluent people that are at or near retirement. Whenever we publish videos or content, all the engagement we get is from people that are between 45 and 65. So we start there, helping them with their decumulation needs, with their lifetime income needs. Once that's been deployed and everybody understands what it is and how brilliantly it works, then the next phase is to start getting people engaged and saving into it in order to have the required amount. Just Quick stat note, in the US, I've been reading some research saying that people believe they need $1.1 million to be able to retire. But if I'm not mistaken, something like 6 out of 10 only have $500,000 available to them, which is obviously a big disaster. But if we trust the research of ETH Zurich, then we can close the gap substantially between the $500,000 savings and the 1.1 they actually need.
How do you invest the assets?
That's a very important question. I've been saying for the last few years, and I don't know if it was at the last event I would have mentioned it, but everybody's been pushing in the direction of target date funds and lifestyle funds. And I've been saying, hold on a sec. These are investing in equities more or less at all-time highs, and they're investing in bonds at all-time low yields. I just thought, this is not safe to put pension money into. I've been saying this all along, we can't do that. We should look for a more robust, more diversified portfolio, even if we have to pay higher fees. But what we decided last year, and especially on the back of all those lifestyle funds from the big names dropping 30%, we're just going to start by using federally insured bank deposits. So I'm sure you've seen all the headlines out of the US. If you put deposits in the right way in banks, you can get 5% risk-free return guaranteed by the federal government. And for us, 5% is plenty for a tontine to work really well. So for now, we're not taking investment risk. Later on, we will start plugging in different models, and eventually we'll start doing even commodity-backed gold, tontines, and dare I say it, possibly even BTC.
It's obviously a short-term view. If we hit a recession in the US and the Fed is lowering the rates again, then the 5% will be history pretty quickly as well.
100%. We need to have the other solution ready, the other model portfolios assembled. There's no rush to deploy them at this minute. I've been looking at the interest rates this morning, and it seems like there's still an expectation that for the next 4 months, they're going to be increasing. The other thing is we've realized that if you're a gold book, and you only want to hold gold for the next couple of years, and then we have other people that want to hold the world index, or some people just want bank accounts. Actually, it's fine. They can all be in the same tontines. They have their own individual investment account where the money's growing, hopefully, but they still benefit from the tontine risk-sharing mechanism. It's an improvement on what we had before.
I think the practical questions that we always had is if you're a couple, there's no shared account on a tontine. Or is there now in your structure? Because individual accounts, husband and wife, need to split your wealth and put it in 2 separate tontines to be covered.
In the US in particular, it's even more complex. So it's taken me 14 months to work out all the ways to market for an individual account. And now we're working on the joint tontines because yes, it's very important, but the tax rules around it are very complex. So we're still fine-tuning to get a version that we're happy with. In the meantime, there's nothing to stop the main breadwinner at least securing their lifetime income. To an extent, they can do it for the spouse, but there's a little bit more work required.
When we started off 5 years ago, we had conversations also with the Inter-American Development Bank, and this is also a very attractive solution for developing countries that might not have a pension system yet. But really the biggest capital markets, the biggest economy in the world is still the US. You would have your hand full trying to capture that market, and you yourself would be quite stretched doing the social good thing, but with lower value, lower amounts in developing markets where maybe socially it would have a huge impact as well. Is there kind of a franchising or so where you can create a satellite then? Because the US clearly would take some time to penetrate.
The US will give us reference numbers. As a hedge fund manager, you want the first 100 or 200 million under management to be taken seriously by anybody, and $1 billion gets you into the big leagues. In the pension world, $1 billion is bare minimum to be taken in any way seriously, $1 billion. But I think we can get there very quickly in the US. And once we have that, we've now got the ability to just talk to regulators, governments, and the development banks that you mentioned, say, look, it's working fantastically. Let's start everything moving in these countries, because we've spoken to development banks about doing regional tontines where the underlying investments will be infrastructure in the countries. It has global potential. It will be the default global pension system, I think, within 10 years. But it just needed someone to go first, and we will be doing that over the next few weeks, months. If you look at countries like Japan, everybody's got their money, well, in the bank or under the mattress, because they don't want to take investment risk, because these people are mature now. And they don't know how long they're going to live because they're Japanese, so they can easily live till late 90s. They can't be spendthrift with their money now. They really don't want to spend it because they expect to live a long time. But actually, if you think about it, with a tontine, you're taking the same investment risk as in putting the money in bank deposits, But now, instead of you worrying that you're going to live a long time, you're capitalizing on the fact that you believe you're going to live a long time. So it's a perfect product for Japan and Korea, no doubt.
The challenge in Japan specifically is if you take your subway and you see the bank advertisements and you do a term deposit for a year, then you still get like 0.47%. It's just still the zero environment. And we see if Ueda is changing that as the new governor. Everybody been watching closely the first meeting press conference, which just happened last week. And now the eyes are on June and the yield curve control. This is a macroeconomic question, right? If you look at the US, and we've already got Silicon Valley Bank and now First Republic going under the losses that they had on the bond portfolio. And there's a Bank of Japan chart as well that shows the losses on all the banks aggregated last year. We'll have other problems, I think, when the interest rates goes off the zero level here in this country as well.
It's going to be crazy. When we eventually get to Japan, which I hope is as soon as possible because I get to spend more time there, is that we probably shouldn't try and compete with the banks by advertising on the subway. We should probably go direct to the kids, because the way it stands right now is that if the parents sit on the money until they're deep into their 90s, if I remember correctly, when they pass away, then there's 50% inheritance tax. So some of the money will go to the kids. Those kids will now be 70 themselves, and it's too late for them to do anything with the money. But if you can get through to them now and you say, look, have a conversation with your parents, you can secure a lifetime income that rises over time. You don't need to worry about this, using only 25% of your capital. The other 75% you could start passing on to the next generation, gifting it. I think gift tax is 10% or something like that. Maybe that's a better communication channel for us to go through.
Totally. And it's interesting because you currently, and this is really over the last few weeks, I would almost say, it's a bit of a confluence of stock trading apps coming up. We had the payments wave in fintech and the robo-advisors and so on. And the big problem in Japan is really still the financial literacy question. It's not a question of how many asset management companies you can bring to have an offering, because the demand isn't there. People, as you said earlier, where people don't put their money into the market, to keep it under the mattress. And you can have more asset management companies, but if nobody's buying the funds, then that doesn't matter. There are different approaches some of the startups are taking now to change that behavior and help people be more comfortable with making these financial decisions. So we had a few weeks ago Habito, which is taking an interesting approach to give you in the app a live person to talk to, because you need reaffirmation that whatever you buy an insurance policy or you're making an investment, that's the right choice. And then there are at least two, and probably more coming, stock trading apps where you get the Facebook or Instagram communication as well. And you can see what other people who might be good at that stuff doing. You can copy trades, maybe your portfolios. So they're coming now. And the reason why they're coming is, I think, trivial, because they all start with US trading, ETFs and so on. And if you're a broker-dealer in the US and you have client funds, then you can invest in and get the interest income. So it actually became pretty profitable, at least last year. So there's a good market for this. That's the type of apps and the generation. When they get used to it now, that's a good hook for them getting in and make them think about term retirement, etc.
The way I always think about it with younger savers is that the problem with younger savers and pensions is that they think they're going to be young forever. And that's a problem when you're encouraging them to save into a normal pension product. But when you're talking to them about putting the money into a tontine, now that belief encourages them to sign up and save more, because the more they believe that they're going to stay young forever, they're obviously going to benefit. If we manage this correctly, I think you'll find that we can increase the savings rate as well.
We've always talked about you're betting on yourself to live longer than the next person. Maybe that also incentivizes you to do more for actually being healthy, going to the gym, doing some weights as you get older and lose some muscle, and not drinking that much, so on. Everything that Japan is doing in terms of the social aspects of investments, it still fits in super nicely. You didn't cover all the juicy stuff from the early 20th century in the US, when these schemes actually were in place and then were abused. Like anything in the history of finance gets abused at some point 100 years later. So it seems people get comfortable with it again because there's enough academic research backing it as well.
I'd always hear about the robber baron era in the UK, not quite realizing it was the time I was talking about. But essentially all the insurance companies, what was it? The Equitable launched 150 years ago now, I think. Within 3 months, every other insurance company replicated it. They capitalized on the tontine effect because they knew everybody would buy it. And over half of the households in the US did buy into a tontine. The problem was they exploited the consumers. They were charging ridiculous fees. They were investing in private assets, which they should not have been doing. And they were tampering with the membership ledgers. Rightly, the New York regulator ruled out all of these toxic bits that made it super profitable for the insurance companies. The insurance companies were forced out of the market. And I don't see them coming back into the market anytime soon, even when we bring it back. But obviously, the whole point of the name of the company is that unlike tontines in the past in the US, we're the tontine you can trust.
I think that was a perfect ending statement.
Okay, fantastic. Absolute pleasure to be on again, Robert. I just hope we can do this again in person quite soon.